Good afternoon, everybody. Happy Friday. It's been a busy week in the Frank Funds offices. We've been doing new technology integrations with Iris and their API, so it's been very, very busy getting all that sorted. Let's hop straight into the five biggest things and developments for this week. Chinese PMI came in at 49.5, which was a contractionary reading. That was a decline from the prior reading of 50.2. It just really continues to show that internal demand is having a lot of shortfalls, and the Chinese government really needs to do something to try to support their economy over there. The Bank of Japan held their interest rates at negative 0.1%. This was in line with our market expectations. The yen USD went through 150 after the announcement very, very swiftly, but over the second half of the week has somewhat reverted back around that level once again. Big part of the catalyst there was a weakening US dollar. Yield curve control was also mentioned, and it was increased from 1 to 1.25%. Third point, New Zealand unemployment rate came in at 3.9%. Prior reading was 3.6%. The key reason there was an increase in the participation rate of people looking for new work. And a lot of the data suggests that families generally are looking for more work to pay for this new environment of higher interest rates and things and at higher inflation rates, where things are just costing generally just a little bit more. There was a reduction in the employment change, and it was at the lowest reading since November 2020. Fourth point, the FOMC held interest rates at 5.5%. Jerome Powell continued to reiterate that they want to take a wait-and-see approach because they really do think that the effects of this very aggressive interest rate increasing program is still yet to be felt fully through the economy. But they have reiterated that they do think that there will and there is still more work to be done, so they're not ruling out further interest rate increases. Bank of England also held their meeting this week, and they have continued to hold interest rates at 5.25%. They tried to really reiterate the hawkishness of the statement, which is essentially saying, similar to the FOMC, that there's more work to be done and that they think that they really want to get interest rates or inflation down to their long-term average, back down to their target of around that 2 to 3% mark, and there is still obviously a lot of work to be done. This has been very consistent over their last few meetings as well. The VIX, if we have a look here at our basket of futures markets that we monitor, like I say each week, some of these are included within the universe of our multi-strategy hedge fund. Again, some of these are not included, but the vast majority of them are included. Gives us a really good snapshot of what is moving in the markets on a week-to-week basis. There are some things that are being driven by macroeconomic events, and some things are just driven by sentiment and trends and momentum. This week, probably the most notable thing is that you can see the VIX index has sold off around about 20%. That is really a reversion from what we saw over the last 3 months, where the S&P 500 was down around about 10-12%. Same with the Aussie share market. Since the end of July, it was down around about 10%. So that sell-off in the VIX is just really in response to the big reversion that we are seeing in global equity markets. The Nasdaq, Nikkei 225 and the S&P 500 were all up over the course of the week over 4%. A lot of this is coming out of very, very extreme oversold conditions, which I've spoken about to a number of investors this week and last week, and it is really a short squeeze cover. We do think it is a short squeeze at the moment. However, we do feel that no, it should continue for November, and then you have a seasonally very strong December as well. US Treasuries also rebounded on softer economic data out of the US, and we also saw copper and iron ore rose in response to this rebound in equities with a bit of risk on investment sentiment hitting the markets. We also saw weather forecasts for El Nino over the last little bit actually coming out and saying that they were slightly more favorable than what everybody had expected. And in turn, we saw orange juice, corn, ethanol, soybean oil, and wheat all sell off and move lower. For the Aussie share market, here's a basket of any or companies that are with a market cap in excess of 10 billion on the ASX top 200. And you can see that over the course of the week, some of the biggest rises. We can see here CBA, NAB, ANZ, Westpac, all leading the market higher and having a good solid week. Goodman and Centre, they came out with updates, and there was some data coming out saying that there was an increase in demand for commercial space. In the materials sector, BHP, Fortescue, Rio all had very good weeks, led by a rebound in iron ore and a bit of a continuation there as well. Some of the worst performers, Northern Star, PLS, Pilbara, they continue to have weakness. Northern Star was a bit of a flow-on effect from what's going on with Newcrest and also Newmont, but then PLS was suffering because of declining lithium prices. The worst sector, as you can see with the red, Woodside, Santos, in that energy space. Crude oil didn't really help because that was down over the course of the week around about 1%. Here we have the frame funds trend barometer, and you can see that we have started to more recently see some short-term and long-term trends emerge. However, we are still struggling to see a continuation of trends continue to stay at these elevated levels, which is really what we want to see, like we saw through August and also middle of September. However, we are starting to see some commodities really go through these key levels that we want to see them, which is a combination of both short-term and long-term trend points, which generally means that our multi-strategy hedge fund will be taking larger exposure through those levels. Outside of that, hope you have a great weekend, and I will see you again next week. Thanks a lot. See you then.